Just 3 months. That's all it took for Ford Motor Company to lose $800 million in operating profits, a figure so big it sent shockwaves through Wall Street. By the end of the year, that loss could swell to $3 billion. What happened? On the evening of July 30th, Ford released its second quarter report from its headquarters in Dearborn, Michigan. Hidden in the numbers was a brutal truth. President Trump's new 15 to 20% tariffs had taken a direct hit on the company's supply chain. This wasn't just a paper loss. It was real money vanishing from Ford's operations. The report placed this tariff burden right on the cash flow statement, giving it its own category. And within minutes, markets reacted. Ford shares dropped 4.2% in after-hours trading, with trading volume more than doubling. That's not normal behavior. It's panic. To make it worse, this wasn't even the full hit. Ford's earlier estimate was $2.2 billion in annual losses. Now they had to raise it to $3 billion. That's a $1 billion revision upward in the middle of the year, and it lit up trading floors like a fire alarm. So why does this matter? Well, because Ford is not a small company. It's actually one of America's most iconic automakers, the maker of the F-150, the Mustang, and really the backbone of thousands of jobs in the U.S. auto sector. If Ford is bleeding this badly, then something big is happening. And that something is what we'll break down next. Not just a tariff, but a complicated 5-layer cost trap that's squeezing Ford from every direction. At first glance, you'd probably think Ford's trouble comes from just one thing: a tariff slapped on foreign goods. But when you look closer, you realize the damage is layered, kind of like a financial onion, and each peel stings a little more. The first layer is what most people see: the physical tariff at the border. When Ford brings in Canadian aluminum and Mexican steel, they now pay up to 20% more. That alone adds millions to their raw material costs, especially for big, heavy vehicles like pickup trucks. But it doesn't stop there. The second layer is insurance. Since tariffs raise the declared value of the goods, freight insurance premiums go up too. Ford now pays an extra $8 per ton just to ensure the same shipments it was bringing in before. The third layer is hidden in banking. To import these materials, Ford needs to file customs paperwork backed by standby letters of credit. Banks charge a hefty 1.1% commission on these, plus interest. It's like paying a toll just to submit the forms. The fourth layer lives in Ford's accounting books. Here the problem is timing. Ford still has some cheaper pre-tariff materials sitting in inventory, but as soon as they switch to the newer tax materials, their paper profit margins collapse. It's a FIFO versus LIFO mess, and it makes Ford look profitable one quarter, then not the next. And the fifth layer? It's about delays. Even when Ford wants to raise prices to cover the new costs, they can't do it fast enough. Dealers resist. Buyers hesitate. So the company is stuck eating the cost temporarily, which crushes cash flow. Put all these layers together, and you get this: a $960 average tax cost per vehicle. For an F-150, it's over $1,800. For a Mustang Mach-E, which uses expensive nickel-based EV parts, it's $1,390. And for smaller models like the Maverick Hybrid, it's still $540. These aren't rounding errors. These are price shocks. And they're only just beginning to ripple through Ford's business. Next, we'll look at the area getting hit the hardest: Ford's electric vehicle strategy, and how tariffs are derailing the very transition meant to save the company's future. For years, Ford has bet big on electric vehicles. The plan was simple: use the profits from its best-selling trucks, especially the F-Series, to fund the shift to EVs and compete with Tesla. But now, that plan is falling apart, and tariffs are a major reason why. Let's start with the math. Ford began 2025 with a bold commitment. It would spend $12 billion this year on electric and digital infrastructure, new battery plants, EV assembly lines, and future-focused factories. But after the second quarter, that number was slashed to $8.4 billion. One-third of the investment? Gone. And it's not just about money. It's about momentum. The company had to delay its next-generation Super Duty refresh, one of its most profitable models. Without the cash cushion from truck sales, now weakened by tariffs, even high-priority launches are being pushed back. That hurts Ford's ability to stay competitive in the market. But It actually gets worse in the EV supply chain itself. Take the Mustang Mach-E, which is Ford's flagship electric SUV. Its battery cells come from China, and now they're being hit with a 20% tariff. That one change added $2,060 to the cost of each battery pack. For some trims, this basically wipes out all profit, meaning Ford is selling EVs that don't make any money. To adapt, Ford is rushing to build a new battery supply chain in Tennessee in partnership with Northvolt, but that plant, Blue Oval City, won't be ready until 2027. Until then, Ford is really stuck between a rock and a tariff wall. Even worse, the Department of Energy removed the Mach-E from its list of EVs eligible for tax credits because the battery materials come from countries the U.S. now flags as problematic. That's another $1,800 price increase for consumers overnight. So, what's the result? Ford's vision of a clean electric future is being held back by outdated trade tools. Tariffs meant to protect the industry are hurting innovation, slowing down electric vehicle adoption, and, well, throwing Ford's roadmap into chaos. And the deeper problem? As the electric vehicle investment slows, so does Ford's ability to stay profitable. Next, we'll break down exactly how tariffs are tearing into Ford's profit margins, and why the company's financial foundation is getting shakier by the quarter. Tariffs don't just raise prices, they shrink profit margins, slowly and painfully. For Ford, that squeeze is now visible in every corner of its financial statements. Let's start with the big picture. In the second quarter of 2025, Ford's operating margin dropped from 8.4% to 7.1% compared to the same period last year. That may not sound like much, just a bit over 1 percentage point. But in auto manufacturing, that's massive. A small dip can mean billions in lost earnings. When Ford's CFO John Lawler broke down the numbers on an analyst call, he made it clear. 2/3 of the margin loss was due to tariff-related costs. Dig deeper, and the damage spreads across 3 fronts. Gross margin took a 214 basis point hit, thanks to higher material and logistics costs. Scanda expenses, that's sales, general, and admin, lost 108 basis points as marketing budgets and operational overhead absorbed new compliance and customs costs. Financing expenses rose by 21 basis points, mostly because Ford had to hold on to inventory longer while prices adjusted. To keep operations running, Ford stretched its inventory turnover, from 36 days in January to 49 days by July. That might sound like a routine shift, but it means $1 billion in tied-up capital. That's money Ford can't use to innovate, invest, or even stabilize. And here's the catch. All this bleeding forces Ford into awkward, cost-saving strategies that create new problems. For example, instead of redirecting Maverick truck chassis from Mexico to Detroit, Ford is now rerouting them to Charlotte, North Carolina, and using a kit completion method to avoid taxes and hit the required 50% U.S. content. It saves some tariff dollars, sure, but it adds $18 in labor costs per vehicle, slows production, and gums up the logistics chain. The bottom line? Ford is now spending more money just to stay afloat, and making less on every vehicle it sells. The company isn't collapsing all at once. It's slowly leaking profitability, one tariff-inflated invoice at a time. Next, we'll look at how this financial pressure is pushing cracks through the supply chain itself, from metal and electronics to labor and logistics. Tariffs don't just hit the company at the top. They ripple all the way down the supply chain, breaking connections, delaying parts, and putting suppliers under serious strain. At Ford, that ripple has become a shockwave. Start with raw materials. The galvanized sheet metal used in pickup truck beds just got a lot more expensive. A 310-kilogram sheet metal kit, the kind used in an F-150 bed, now costs $629 more after tariffs. Ford tried to solve this by restarting its Dearborn rolling mill 3 months early, but the plant wasn't ready. When they pushed past the mill's normal speed, it caused a 100-degree scalp crack, halting production for 2 full weeks. That's just metal. Let's talk electronics. Ford's infotainment systems used to rely on Chinese sub-assemblies, now subject to a 20% tariff. So Ford switched to alternative suppliers in Vietnam and Malaysia. Sounds smart, right? But by the time they added freight, insurance, certifications, and extra lead times, the new supply chain was only $28 cheaper per unit than the original Chinese parts. The savings were barely visible, but the delays and complexity were very real. Even aftermarket parts aren't safe. A brake caliper made by a supplier in Ontario got hit with the tax, increasing the per set cost by $16. In response, Ford's Motorcraft division raised the retail price of the caliper from $210 to $250. That might not sound like much to a dealership, but multiply it across thousands of parts and repairs, and it pushes repair costs and insurance premiums higher for every driver. Suppliers are also starting to buckle. The Alton aluminum foundry in Illinois paused its global piston line. A plastic mold maker in Elk Grove Village delayed headlight mold deliveries by 2 months, citing an $8,000 spike in test mold costs. And when suppliers try to renegotiate contracts to survive, Ford activates tax-sharing clauses, spreading the tariff pain between itself, the supplier, and the customer. Labor isn't immune either. 200 workers were temporarily laid off by a Michigan steering system manufacturer, and this is only the start. What we're seeing is a web unraveling, where every disrupted shipment or unexpected cost creates new problems further down the chain, and all of it started from a tariff policy designed to help domestic producers. Instead, it's tying them up in a logistical knot. Next, we'll follow the damage to the dealership front, where rising costs are colliding with struggling consumers and making cars harder to buy. If you really want to see how tariffs hit home, walk into a Ford dealership. Let's talk numbers. In the second quarter of 2025, the median transaction price for an F-Series truck hit $61,000. That's already a steep price for most American families. But now add in higher insurance premiums, rising interest rates, and limited discounts. And suddenly even loyal Ford customers are walking away from the lot. Here's what's happening behind the scenes. Because tariffs have raised production costs, Ford has had to raise prices on many of its models. But at the same time, the average auto loan interest rate has climbed to 11.4% annually. That's a double punch. The truck is more expensive and the loan to buy it is more costly too. No surprise then that loan approval rates have dropped. In early 2025, banks were approving 63% of retail auto loans. By July, that fell to 58%. More people are being priced out. Not because they don't want to Ford, but because the math doesn't work anymore. You might think Ford could fix this with 0% financing, a classic incentive tool. But here's the problem. Offering 0% loans costs Ford money. And now, they can only offer them on select models with inventory risk, not on bestsellers like the F-150 or Mustang Mach-E. If Ford eats the cost of financing, it loses even more on the sale. So the company is trapped between keeping margins or keeping buyers. And it's not just the loan. Tariffs on foreign-made parts are even raising insurance premiums. That Ontario-made brake caliper we mentioned earlier? Its price increase caused insurers to raise their repair cost estimates, adding 5 basis points to the U.S. Auto Insurance Premium Index. That's a hidden cost consumers won't see on the sticker, but they'll feel it when their policy renews. All this adds up to something deeper than just sticker shock. It's about consumer confidence. When buyers walk into a dealership and realize they can't afford what they used to, and the incentives they counted on are gone, it changes their behavior. They delay purchases. They buy used. They look elsewhere. And for Ford, that means fewer sales, slower inventory turnover, and even more downward pressure on profits. Next, we'll zoom out to the broader policy question. Are these tariffs really protecting American jobs and industry, or are they quietly doing the opposite? Tariffs are supposed to protect American jobs. That's the message behind them. Bring manufacturing home, punish foreign competition, and revive domestic industry. But at Ford, the reality on the ground tells a very different story. Let's start with workers. At the Kansas City Assembly Complex, Ford recently cut weekly overtime from 46 hours down to 38. That may not sound like a layoff, but to the people on the line, it's a serious pay cut. And it's not just in Kansas. Across Michigan and Illinois, temporary leaves, reduced shifts, and delayed production schedules are becoming more common. The United Auto Workers Union isn't staying quiet. They've described the situation as, job losses disguised as cost control. And they're right. Ford hasn't done mass layoffs, but it's quietly bleeding labor hours and shuttering projects. That's real income lost in real communities. The ripple effect hits everywhere. Small suppliers are suspending operations. Machine shops, mold makers, aluminum casters. The entire downstream ecosystem is feeling the pinch. These are the exact businesses tariff policy was meant to help, but instead of getting stronger, they're being priced out of raw materials and pushed to the edge. And what about the electric future? The EV transition is, well, slowing down. Factories are delaying launches, battery costs are up, and even consumer adoption is stalling. With tax credits removed and prices rising, electric vehicles are actually losing their price advantage over gasoline models. That has a climate cost, too. As EV sales dip, so do the chances of hitting national emissions goals. The tariff isn't just hurting profits, it's pushing the United States off track from its Paris Agreement targets. Meanwhile, the Federal Reserve really can't ignore what's happening. Inflation is ticking up in the auto sector, fueled partly by tariffs and partly by supply chain disruptions. And with inflation high, interest rates stay high, making it even harder for consumers and companies to borrow, invest, or grow. So, the question is no longer whether tariffs protect U.S. industry. It's whether they're doing more damage than good. And Ford, once the symbol of American manufacturing strength, is now at the center of that debate. Next, we'll look at the broader financial fallout, from credit downgrades to lost investor confidence, and how this crisis could reshape Ford's future. The damage from tariffs isn't just showing up in factories, supply chains, or dealerships. It's now baked into Ford's financial future, and investors are starting to panic. Shortly after Ford's July earnings report, Bloomberg revised its EPS forecast. The expected earnings per share for 2025 dropped from $2.70 to $2.30, a sharp cut that signals serious doubts about Ford's ability to recover. On top of that, S&P downgraded Ford's credit rating outlook from stable to negative. That means lenders now see Ford as a riskier bet. Investors usually look for safety in long-term projects like green bonds, instruments meant to fund clean energy and electric vehicle infrastructure. But with profits squeezed and risk premiums rising, Ford has effectively lost access to that financing window. The company's Blue Oval battery plants, which were supposed to power its EV future, are now facing potential delays in project funding. Credit default swaps, a kind of insurance against Ford going broke, have also spiked. The 5-year CDS premium jumped from 72 to 95 basis points, meaning investors are now paying more to hedge against a possible Ford default. And that's not just numbers on a screen, it's a warning light. Wall Street sees trouble ahead. With cash flow down, EV investments cut, supply chains strained, and financing harder to come by, Ford is now being forced to choose between surviving today and preparing for tomorrow. The company's $8.9 billion dividend plan, once considered untouchable, is now under review. That's a big deal. When dividends are threatened, shareholder confidence evaporates. But perhaps the most symbolic moment is this. Ford, the American automaker that once built the arsenal of democracy, is now asking suppliers to share the cost of the tariff. In its contracts, there's a clause allowing tax burdens to be divided, partly to Ford, partly to suppliers, and partly to customers. That's how deep the financial strain has become. In the end, the tariff didn't just impose a tax. It restructured Ford's entire business model, weakened its ability to compete, and left deep scars that won't heal quickly, even if the policy is reversed. So where does this leave us? It leaves us staring at the limits of economic nationalism. When tariffs are used as a blunt weapon, they don't just hurt foreign competitors. They can cripple the very industries they aim to protect. And in Ford's case, the damage is already here. $800 million in quarterly losses, a $3 billion annual hit, and a shrinking electric future. What do you think? Are tariffs saving American jobs or sinking them? Let us know in the comments below. And if you found this breakdown helpful, be sure to subscribe, like, and turn on notifications so you don't miss our next deep dive into global trade, economics, and industry. Thanks for watching.